I am very cautious on equities for the next, several months. I think that there are attractive areas longer term, but until we have more clarity on this liquidity situation, we see basically a storm on the horizon. It's unclear how they're going to handle it. Now, if the market correctly sniffs out to say the Fed's going to blink and they're going to pivot their liquidity, kind of like they already partially did in
Yeah, yeah.
March, it's possible the market, say, front runs that, and then it never gets the big sell-off that some of the bears expect. On the other hand, and that's part of why this is a challenging market, because it's so human driven. We're basically trying to predict what a handful of individuals like Yellen and Powell are going to do.
The yield curve, the difference between the interest rate on short-term and long-term government bonds, has been used as a leading economic indicator for years. According to Lyn Alden, central banks' ability to address rising inflation is being hampered by unsustainable levels of debt, and restricting economic growth reduces governments' ability to bring down deficits. Because of the ebb and flow of the political cycle, crucial policy decisions regarding fiscal restraints are often put off. This leads to a cycle of rate hikes followed by bailouts. All investments, even tried and true ones, are now more precarious as a result. If the problems between banks and their depositors are not resolved, investors will start looking for safer banks, and eventually they will try to get out of sovereign currencies entirely. Capital controls are implemented when governments prioritize the safety of the system over the safety of its citizens. In the same toolkit as gold seizures and possible Bitcoin restrictions is the denial of licenses for narrow banks. She also mentioned that in 2020 and 2021, as a result of fiscal stimulus, people deposited a lot of money into banks. The deposits are used by the banks to purchase the low-yielding securities on the market. As a result of the bank's heavy buying of securities when rates were low, the value of their fixed income holdings has declined over the past year as a result of the rapid rise in interest rates. Many banks have significant unrealized losses on assets that could be sold.
Main thing hitting banks is that they invested in very safe assets, but at wrong prices. And now they're facing, their deposit rates going up. They're facing unrealized losses, and then they have a challenge where they can hold those assets to maturity, but the market doesn't always let them do that, especially if they have deposit runs and things like that. So earlier, last month there was a liquidity crisis. Now I think it's evolving more towards a profitability problem because, while the Fed and others have these facilities in to prevent ongoing liquidity, or at least reduce the severity of some of these ongoing liquidity problems, banks now face an issue where, they have some of these long duration assets that might be relatively safe, and many of them are, but then they have rising deposit costs overlaid on top of that. And if you look at the Federal Reserve's own balance sheet, I mean, they're in the red. They're operating at a loss now because their liability is adjusted upward very quickly. That's a policy they decided to do, and essentially we're seeing the slow motion version of that happen to the commercial banking sector, where their deposit side is slowly kind of catching up with a big lag compared to where the Fed's own rates are. And you see that more so happening in the long end of the medium and smaller banks, whereas larger banks have more overall position to not really raise rates as quickly because everybody wants an account at those bigger banks. And so right now there's a kind of I think an ongoing profitability problem among those small and medium-sized banks. And then it's obviously further exacerbated by some areas of actual credit concern, things like autos, things like commercial real estate that are well-known issues at this point. I think it's going to be a mess. And I think one of the, going back in history again, looking at, say, the 1940s, which is the kind of the closest macro environment, oddly enough, to the 2020s environment, that was the last time they tried to come off the zero bound. When they were on the zero bound, they had inflation, and they tried to raise rates off that zero bound. And the question is, how do they handle it? And the answer was an absolute mess. They basically had to, they did yield curve control. They inflated away a lot of debt, and then they tried to slowly come out of that zero yield environment back to getting back towards positive real yields. And it took them quite a long time. And that was an environment with partial capital controls. That was an environment of no social media. Things happen slower, so you can you get people into these silos and you can slowly change things. I mean, gold was banned for 40 years for Americans. It was kind of a weird environment. And essentially, in this, now we're in a fourth turning again, and essentially they're doing this. They're in a same environment where they're obviously trying to get off the zero bound in a very indebted environment. This time, I think the challenge they're running into is they actually took a different course in the playbook. Last time they did basically what Japan's doing now. The yield curve control raise things slowly. This time they tried to rip the Band-Aid off and just jack rates up. And basically it's emanating into the banking problem, and it emanates into real estate. And I think we see these cascading problems. And I think the challenge is that they eventually face kind of a Minsky moment where they're not able to handle both at the same time, where they basically are in a situation where they try to normalize rates, but that they still have to end up providing liquidity to the treasury market and some of these other kind of core markets. And I think they're going to be in that kind of weird environment again, with the key difference being that we are in a different technological environment now, where we have social media, we have rapid real-time data, we have more free flow of capital, at least for the the Western world. And I think that's the challenge they run into, is that they're essentially applying a 1970s kind of inflation fighting playbook to a situation that's actually more like the 1940s. And I think it will result in some pretty extreme outcome. Fed has huge unrealized losses. They have, unlike most banks, they actually have an operating loss, meaning that their liabilities are yielding higher than their assets, which is historically very unusual. Now, unlike a normal bank, they don't have to necessarily make a profit, but over time, it does start to impact a number of things. One is it impacts the Treasury, because the Treasury used to get a revenue source out of the Fed. Now they don't get that revenue source anymore. And then longer term, if this goes on long enough and they dig themselves in a deep enough hole, it actually does kind of bring up questions around central bank independence, because kind of central bank solvency is kind of one of the factors that at least leads them to have some degree of central bank independence compared to what you get in kind of a banana republic, where there's really no independence at all. So over time, if you were to have them hold that level for a sufficiently long period of time, and you have commercial banks have to slowly raise their deposit rates in order to compete with money markets and T-bills, you'd eventually have them all start to look like that sheet, essentially. They'd all start to have these kind of negative profitability, and they would start to eat into their capital. And so I think that they're going to have pretty insane decisions ahead of them, where sometimes they're facing both inflation and recession problems at the same time, or at least kind of back to back. And it's the worst possible environment for a central bank to navigate, because if they have a 1970s style problem with low debt and high inflation, the answer is to tighten. Whereas if you have the combination of very, very high debt levels and inflation, that's when they face kind of the impossible scenario. The debt ceiling issue might strike more quickly than Yellen has previously estimated. I'm sure there are a lot of people doing really deep research on that. But I think essentially that is a huge catalyst to be aware of, because ironically, it's not necessarily the debt ceiling to focus on. It's what happens right after it. When they resolve that debt ceiling and the Treasury tries to raise their cash balance back to their normal target level, that's a huge liquidity withdrawal out of the financial system that is already very tight on liquidity. So, autumn of last year basically was kind of a partial turning point in liquidity, because for most of last year, you had the Fed drawing down their balance sheet, and that was obviously pulling a lot of liquidity out of the market. But then starting in the later part of the year, you had the Treasury really begin to offset that to a significant degree. They were pushing liquidity back into the market while the Fed was pulling it out. And so you actually had somewhat neutral liquidity conditions overall, kind of this choppy sideways kind of stagnant liquidity environment. And if you get to the end of that, where the Fed is still trying to draw down, and now the Treasury is trying to refill its account later this year, that's a double negative whammy for liquidity, and it might cause one or both of them to have to course correct. But the path between there and here and there, I think, is going to be fraught with volatility. If they reach very low cash levels, they can shut down the government for a period of time to extend the period that they can operate without an outright default on some of the more either essential payments or the debt itself. So they can extend it with that a little bit, but that obviously has an economic impact on its own right. And then essentially when they eventually have the debt ceiling impasse, one or two things has to happen. Either the Federal Reserve might have to provide more liquidity, which is awkward given their current inflation mandate, or the Treasury, for example, can shorten their average duration of Treasury issuances and try to draw liquidity out of the reverse repo market. But that also, it doesn't make sense from a number of standpoints. That's the most expensive part of the curve right now, and it also deviates from their normal kind of plan of maintaining rather consistent average durations. So I think that's going to be a big challenge for them, and it's just this multi-month period of, we see decelerating profit margins, we see decelerating growth, we see across the spectrum, if you look at all these different parts of the economy, we see labor starting to weaken to varying degrees, even though that's traditionally a lagging or coincident indicator compared to some of the others. Even that one is beginning to show somewhat fairly early signs of weakness now. And I think a lot of recession indicators are kind of pointing towards that same part of the year, as you pointed out, with the liquidity crisis. And I think that cash, T-bills, cash equivalents, not relatively low volatile stocks are ways to maybe weather the storm until we have greater clarity on how they're going to handle these kind of extreme environments.
According to Terra Wolf, which has the option to add an additional 50 megawatt of mining capacity at the Nautilus facility, the company successfully deployed its full share and phase 1 of the nuclear-powered Bitcoin mining facility 50 megawatt, and 1.9 per second ahead of schedule. Since the Bitcoin mining impact on climate change can now be quantified, this is very bullish news. That's all for today's video on Market Empire. We hope you found the insights shared valuable and informative. Don't forget to subscribe to our channel and hit the notification bell to stay up to date with the latest news and insights from the world of finance. If you have any questions or comments, feel free to leave them down below. Thank you for watching, and we'll see you in the next video.